Good evening, everyone, and welcome to PenFinancial Credit Union's RRSP and TFSA webinar. My name is Josh Schulke, and I'll be helping to facilitate the webinar here tonight. As we enter into RRSP season, we thought this would be a good and important topic to cover, so here we are. I'm joined here tonight by our Bunting Road Branch Manager, Jacki Vant, and Matt Price, who is a Financial Services Specialist at our Main Street branch. If at any point you're having technical difficulties, we just encourage you to let us know via the chat function on the right side of the screen. Also, we welcome questions, so if you have a question at any point, feel free to let us know on the right side of the screen in the chat area as well. We actually allowed some more time for questions this evening, so the content portion of our presentation is a little bit shorter, as we figured a lot of viewers would have many questions. So if you have any at any point, feel free just to let us know, and Jacki and Matt will do their best to answer them for you. Without further ado, I'm going to start this off with a little bit of a fun video to kick us off, and Jacki and Matt will take over after, so enjoy.
In a world of your money, two diverse investment strategies compete for your favor. Which one will be victorious? Should you put your money into a TFSA or an RRSP? And the answer is, it depends. Sorry, I know, you're probably like, oh, what? What a rip! I hate non-committal endings. Ooh. But just let me show you what I mean, all right? Okay, let's start with the Registered Retirement Savings Plan, or RRSP. Now, if you invest in a RRSP, you only pay tax on the money that you take out of it, and you can earn a pretty sweet little income tax refund in the meantime. Now, most people assume that an RRSP is only to help you save for when you're old. It's got the word retirement in it after all, but it can help you do cool stuff, like buy a home or go back to school. And the earlier you invest in an RRSP, the better, because the magic of compound interest will help your money grow more and more over time. Now, this investment is particularly good for folks who are already making a lot of money. So, if you're a basketball star, or a hip-hop phenom, or an orthodontist, this might be a great plan for you. Next up, tax-free savings account. With a TFSA, you initially pay tax on the money you put in, but even if you make a million, billion, trillion, Brazilian, even if you make a lot of money off this investment, you don't pay any tax when you pull the money out. So if you're a student or a career newbie with some short-term goals like saving up for a car or a big trip or a boxing kangaroo, a TFSA is great, because you can take your money out at any time, whereas with an RRSP, you're a little bit more limited. So, this brings us back to the initial conflict. What will it be, an RRSP or a TFSA? Here's the deal. Both of these plans have pros and cons, and you may even want to put your money into both of them. But the thing is, I don't know anything about you. I don't know how much money you make, or what your goals are, or if you like your ice cream in a cup or a cone, or just directly into your hand like you're just some kind of beast. So I can't really tell you which plan's going to work best for you. But someone who can is called a financial advisor.
So let's start talking about what is an RRSP. An RRSP, or Registered Retirement Savings Plan, are preferred savings plans for many people. You make tax-deductible contributions to the plan and accumulate tax-deferred income in the form of interest, dividend, or capital gains while saving to supplement your retirement income. Contributions are optional and can be made up until December 31st of the calendar year in which you reach the age of 71. There are some advantages of having an RRSP. One advantage is it reduces your net income subject to tax. Contributions up to a set amount are deductible from your taxable income. Earnings in the form of interest, dividends, and capital gains are generated inside the plan and are not currently taxed. It also allows non-taxable transfers. Non-taxable transfers are allowed to other registered vehicles, so you can transfer registered products from one financial institution to another. It also provides a supplementary retirement income. An RRSP can be used to generate retirement income in addition to income received from government pension programs and company pensions. There are disadvantages of an RRSP as well. Contribution limit restrictions. You may want to contribute more to your RSP than allowed by government regulations. However, be aware that excess contributions exceeding a total of $2,000 at any one point are subject to a 1% per month penalty tax. Another disadvantage is the pre-retirement withdrawals. If withdrawals are made from the RSP before retirement, it will increase your taxable income. It will also reduce the projected retirement value of your RSP by the amount withdrawn and reduce the value by the income that would have accrued had the withdrawn funds been left in the plan.
So let's take a look at the different types of plans that are available to us. First, we have the individual RRSP. This is registered in the contributor's name. A locked-in RRSP is an RRSP that originated from a transfer of pension funds. Special rules apply to locked-in RRSPs. A spousal plan is an RRSP in which the higher income earner contributes to their spouse's RRSP. The contributor receives a tax deduction while the spouse is the owner of the contribution and uses the funds for their retirement. A self-directed plan, this is for do-it-yourself investors. It is used by individuals that prefer to choose their own investments rather than using the advice of a professional. And a group RRSP is set up by companies to help their employees save for retirement. The employer and/or the employee can contribute to these. So how much can be contributed to an RRSP? The contribution limit is calculated by taking 18% of the previous year's earned income minus the pension adjustment plus any unused contributions from previous years. So what is earned income? It is income eligible for consideration when calculating the RRSP deduction limit. It includes employment earnings, which are found on your T4, rental income, net business income, and disability benefits that are paid by Canada Pension Plan or Quebec Pension Plan. It does not include investment income, retiring allowances, severance pay, taxable capital gains, and pension income. What is the pension adjustment? This is an amount that reduces the RRSP deduction limit of persons who are in a company-sponsored registered pension plan. It's important to note, contributions can be carried forward indefinitely if they're not used in any given tax year. This can be especially useful in future higher income earning years. So when can we contribute to RRSPs? RRSP contributions can be made up until the deadline for the 2013 income tax year, which is Monday, March 3rd, 2014. Now, one thing to note is that any contributions that are made within the first 60 days of 2014 can be applied to the 2013 tax year or to the 2014 tax year.
So some rules of thumb for contributions to RSPs. Contribute early, contribute often, and contribute regularly. An early start to RSP contributions has a huge impact in growth because of the compounding rate of return. Exercising discipline and investing in RRSPs regularly will also grow the investment at a faster rate. Let's look at a couple scenarios to see how quickly it can add up and to compare the balance at retirement depending on what age you start. So let's say you start to contribute at age 30 with a planned retirement age of 65. Your annual savings of $1,200 with a pre-retirement rate of return of 7%. Your RSP will grow to $184,519 by the time you reach the age of 65. If you were to start to contribute the same amount each year, so the $1,200, but start at age 25, your RSP will grow to $261,144. That's over $76,000 more by starting 5 years earlier. If you wait and start your contribution at age 45, your RSP will grow to $63,162, which is $121,000 less than if you start at age 30, but $197,000 less than if you start at age 25.
This is testament to the fact that the earlier you start to contribute, the better it will be. Time really does equal money. So how long can contributions be made to an RRSP? Contributions can be made up until the end of the year in which the individual turns the age of 71. If there is a spouse and they are less than 71 years of age, contributions can be made to a spousal RRSP until the end of the year that the spouse turns 71, even if the contributor is older than 71 years old. Now, are there different investment options within an RRSP? There are many. This list is fairly large, but is not fully exhaustive of all the options that exist. It's merely to illustrate that there are a lot of options that you do have to invest inside of an RRSP. A basic rule of thumb is the larger amount that a person has to invest, the more diversification they need. Make sure to get the right people involved to learn about your options, such as your PenFinancial advisor. Now, there are other uses for RRSPs, the first of which is the first-time home buyers plan. This allows first-time home buyers to withdraw the funds tax-free from their RRSPs to help finance the purchase of the home. An individual and their spouse or common law partner can each withdraw up to $25,000 to buy or build a first home. This has to be repaid over no more than 15 years, starting in the second year after the withdrawal. Another option is the lifelong learning plan. This is to help finance education for the RRSP holder or their spouse. Like the home buyers plan, RRSP funds withdrawn are not taxable, and up to $10,000 a year can be withdrawn over a 4-year period with a total withdrawal amount of $20,000. The RRSP holder or the spouse must be enrolled in full-time training or post-secondary education, and the first repayment is due 60 days after the 5th year following the first withdrawal. This must be repaid over no more than 10 years.
Let's look at withdrawals from your RRSP. Withdrawals from the RRSP can be made at any time. However, amounts withdrawn are subject to withholding tax as follows. From $0 to $5,000, withholding tax is 10%, $5,001 to $15,000 is 20%, and over $15,001 you're taxed at 30%. There are some disadvantages to withdrawing from your RRSP before retirement. The amount withdrawn is added to your total income for the year and could affect your income tax bracket and marginal tax rates, resulting in additional taxes payable. Withdrawals also result in lost contribution room, so withdrawing the funds early will result in lower net worth as you enter your retirement years. Withdrawals from spousal RRSPs made within 3 years of contributing are taxed to the contributor, but after 3 years, withdrawals are taxed to the annuitant or the plan holder. This is also known as the 3-year attribution rule. So what happens to your RRSP when you turn 71? Your RRSPs must be converted to any of the following before the end of the year you reach the age of 71. It can be converted any time before then unless it's in a locked-in plan which has a minimum age requirement of 55. Your options are to convert to a registered retirement income fund or a RRSP, an annuity, a cash withdrawal, which is not likely your best option as it would result in taxes payable on the whole amount, or any combination of the above. Just a note on locked-in plans, they cannot be converted before the earliest age as outlined in the original pension documentation or age 55. Locked-in plans also have special unlocking features to access 50% of the plan value and transfer to an unlocked RRSP, cash, or to purchase an annuity. What happens to the RRSP upon death of the annuitant? RRSPs can have a named beneficiary or multiple beneficiaries. If the spouse is named as beneficiary, there are no tax implications with the spousal rollover. There are tax implications, however, for the estate if beneficiaries named are someone other than the spouse, for example, the estate or your children. 100% of the fair market value of the RRSP is added to the terminal tax return as income.
Now let's take a look at tax-free savings accounts. A tax-free savings account, or a TFSA, is an account that accrues tax-free earnings. Although contributions to a TFSA are not tax-deductible, there is no tax payable on the income that's earned within them. Who can hold a tax-free savings account? Any individual who is a resident of Canada who is 18 years or older with a valid social insurance number. There's also no maximum age restriction to holding a tax-free savings account. How much can I contribute to a tax-free savings account? TFSAs were introduced in 2009 with a maximum $5,000 per year contribution limit, which is indexed to inflation annually to the nearest $500. The total contribution room for 2014 is $5,500 contribution limit for 2014, plus any unused room, plus any withdrawals from previous years. The 2014 maximum contribution limit for TFSAs is $31,000.
So what can you invest your TFSAs in? Well, there are several investment options that are available in the TFSA. Basically the same as what is available in the RRSP list that Matt had alluded to earlier. And it's quite a long list, but it's not an exhaustive list. Successor holder and beneficiary. A survivor, for example, your spouse or common law partner, can be named as successor holder. The survivor becomes the new holder of the tax-free savings account immediately upon death of the original holder. This transfer has no effect on the survivor's contribution room. The plan holder may designate someone other than their spouse as beneficiary of the TFSA contract, for example, your former spouse, common law partner, children, or a charity. If this happens, the plan is closed upon death and any unused contribution room is gone. Beneficiaries can then contribute to their tax-free savings account if contribution room is available. The withdrawals from a TFSA. Withdrawals of any amount can be made at any time for any reason, provided it's not in a fixed term. Because it is a tax-free savings account, there are no taxes payable. Contribution limit cannot be added back to the TFSA until the following year.
So RRSPs versus TFSAs, where should I put my money? Well, this really depends on two things: your income tax rate during your contribution years and your income tax rate after retirement. An RRSP is the better choice when the income tax rate is expected to be higher during your contribution years and lower after retirement. The TFSA is the winner when the income tax rate is expected to be lower during contribution years and higher after retirement. This slide demonstrates this scenario. If we invest $1,000 at 6% growth over 20 years, we can see that with a higher tax rate later, it's best to choose the TFSA, nets us $449 of more money in our pockets. If we expect the tax rate to be the same later, then we can choose either, as they're both beneficial. And if we expect the lower tax rate later, then it's best to choose the RRSP. Next, we'll just transition to a video that sums up nicely what we've just discussed.
Well, let's talk about the 40-somethings view on TFSAs. Imagine that you've been using RRSPs for 10, 15, 20 years, and you've heard a lot about TFSAs. They sound great. Should you switch from RRSPs to TFSAs for your retirement saving?
Not necessarily true. It's certainly something to consider. But if you're, 40-something and you're earning a really good income, there's value in that RRSP tax deduction that you get each year. So what you can do is, particularly if you expect that your tax bracket will be lower in retirement, then take your tax deduction from the RRSP today, and when you withdraw that money in the future, you'll be subject to a lower rate of tax. The RRSP looks to be the better option in that case.
I think a lot of people like the TFSA because you put the money in, and of course you're using after-tax dollars, but once the money's in, you can invest it in anything, any scenario, right, and you take the money out at any time and it's completely tax-free. Is that flexibility worth something when you're retired and you're trying to come to grips with your RRIF, mandatory RRIF withdrawals and all kinds of taxation issues? Here's money that's tax-free.
Right. Yeah, for sure. I mean, tax-free savings is great in retirement. Another thing you have to think about is there's certain benefits that older people receive in retirement, income-sensitive benefits such as OAS. When you pull money out of the TFSA, that's not going to impact your income-sensitive benefits, no clawback in your
So you're referring to the OAS there, and seniors are very sensitive about OAS clawback. So money pulled out of a TFSA TFSA will not affect your eligibility for OAS. That's an important point.
It is an important point because with respect to OAS, once your net income approaches roughly $66,000, $67,000, the government starts to reduce the clawback you receive. So if you're looking for some additional cash flow, you can pull that money out of the TFSA, you get your cash flow, it does not count as income, therefore it's not going to result in the clawback of your benefit.
In closing, I think you just made a case for using both.
Exactly. I think the key message is we need to save. Whether you're 20-something, 40-something, or you're into retirement, saving is a good thing. And once you figure out how much to save, then you can look at both the RRSP and the TFSA to maximize your financial security.
Great. Thanks, Wilma.
Thanks, Rob.
So just a little bit about PenFinancial Credit Union for those of you listening who are not currently members. We have over 60 years of experience in Niagara, over 15,000 members strong with over $350 million in assets. We currently have 94 employees with 6 branches to serve you, 3 that are located in St. Catharines, 2 in Niagara Falls, and 1 in Welland, as well as our commercial business center located in Welland. We are local and accessible, nimble and innovative. PenFinancial is small enough to care, but big enough to trust. So how are we similar to a bank? We offer the same products and services. Our rates are very competitive. Our branches are located throughout Niagara. We offer internet banking, mobile banking, and telephone banking. There are ABMs across the country that are ding-free. We have a full range of products to help you achieve your financial goals. How are we different from the banks? We are Niagara-based, owned and operated. We are a cooperative financial service organization owned by the people we serve, which are you, our members. Credit unions make decisions based on the best interests of our members. All decisions are made locally. Income is reinvested back into our Niagara communities. We are accessible, transparent, and negotiable. We are genuine, honest, and fair. I'd like to thank everybody for tuning in. I will turn it back to Josh.
Okay, thank you very much, Jacki and Matt. It was very informative. We had a bunch of questions that have come in, so we'll try and get through them. Like I said, if you have a question, if you think of one, maybe during one of these answers, feel free just to type it in the chat area on the right side of the screen. The first question is, what exactly does tax-deferred mean?
That's a great question. I think I can handle that one for you. Basically, there is a difference between tax-deferred and tax-free. Tax-deferred means that when we make contributions to our RRSPs, we get to deduct that from our income. However, when we withdraw those funds from the RRSP at a later date, we are responsible to pay the withholding tax at that point. So it's important to remember that when you're contributing to your RRSPs, when you draw them out later, there is tax payable. However, the goal is to contribute when your income tax, when your marginal tax rate is higher. So when you withdraw, you're paying less tax at that point.
Thanks, Matt. Jeff asks, at what age can I begin to transfer my RRSP into a RIF?
Thanks for your question. You can actually transfer your RRSP to a RIF at any point. However, you can keep your RRSP into the plan until you turn age 71, or sorry, 71, at which point you must wind up the RRSP. Just to note that if you do transfer it to a RIF, there is a minimum payment required that you do have to withdraw monthly or annually. Once you do transfer it to the RIF, when you turn 71, you can withdraw the full amount in a lump sum, which is not recommended because you have to declare it as income. Therefore, there will be heavy tax implications. And so once you convert it to a RIF, like I said, you do have to take the minimum required out of that RIF.
Thanks for that, Jacki. And it looks like this is our final question. Unless anyone has any more, feel free to type them in. This one comes in from Catherine, and it's, what happens if I exceed my TFSA contribution room?
That's a great question. RRSPs and TFSAs do have contribution limits. And basically what happens is, if you over-contribute to an RRSP or a TFSA, there's a penalty that's assessed by Canada Revenue Agency of 1% per month on those excess contributions. So it's great to, if you feel you've over-contributed, to try to take that money back out.
Okay, and we just had one more question pop in, and it's, can you have a spousal TFSA?
No, you cannot.
Okay, simple enough answer. Okay, so it looks like that concludes all the questions. So thank you very much to everyone who submitted one. That officially concludes our webinar here tonight. Thank you once again, everyone, for attending. Friendly reminder that if at any point you want to see any of the past webinars we've done, maybe you missed a part in this one, you can head to the Webinar Center on our website here at www.penfinancial.com. Also, if you have any topics for future webinars, feel free just to send us an email to email us at penfinancial.com, or you can give us a shout on our Facebook or Twitter pages. Our next webinar is scheduled for February 26th, and the topic is all surrounding keeping your identity safe online, so certainly an interesting topic for folks. If you have a question specifically for Matt or Jackie, you can see that their email addresses are listed on the screen here, so feel free to send them an email with your questions. And that being said, that concludes our webinar. Thank you, Jackie and Matt, once again for your information here tonight. Thank you to you guys for viewing, and have a great night. Thank you.